It seems that there was a lot of concern about Portugal, Spain and Italy coming to the market, and now everyone is perhaps looking at the situation saying that it doesn't look so bad. A lot of vote of confidence coming through from Japan and from China as well. Resource stocks doing quite well and the dollar slipping back slightly.
Yes, Eleni, I think certainly the vote of confidence by Japan has been a positive vote for the euro and for the euro region. I think we must just bear in mind that what we're seeing there is that Japan will be buying the bailout bonds. In other words, the AAA rated bonds. They will not be buying any of the junk status bonds or the bonds that are currently in distress in Europe. So although it is definitely a vote of confidence and they join China in doing so, this is basically the bonds that will be used, that have already been used to bail out Greece and Ireland. So if Portugal does actually need the bailout, they will probably also be buying some of the Portuguese bonds, although it's of course issued by the EU region themselves. So after quite a strengthening in the dollar that we saw really on the back of weakening of the EU, I think what we're seeing today and over the last couple of days is really just the market taking some relief from the fact that Japan is sort of joining the likes of Germany and France in providing some backup and relief for the euro region, but still a lot of nervousness around that, the infamous PIGS countries and I believe they now talk about the HICS countries as well, the highly indebted industrial countries, the latest acronym that we've seen come to the fore.
Okay, let's delve into some market performance for 2010 and where we should be putting our money in 2011. Looking at some of the favorite sectors that have already been spoken about, the construction industry, of course, largely ignored in 2010, most concerned about those earnings. Perhaps time to buy. Nerina, if you could just start off by telling us about some of the industries that you're perhaps long on and that you've got a buy order on.
Yes, Eleni, it's quite difficult when you start at the beginning of the year to take a long-term view and to say where should we be positioning our clients, where would we give recommendations for clients in terms of how they should be positioning themselves, taking into account the high risks that are out there in the world. And I think in particular for South Africa, where we really are at the behest of what happens in the developed markets, and where we've seen so often in the past that our interest rates, our currency and so on really results on what happens in terms of foreign inflows into our market. So when we look at these sort of factors, we realize that probably the most prudent way to play the market is to say that you need to have some sort of hedged strategy, that you need to play the relative game rather than the absolute game. And what we like to do at the beginning of a year like this is to say, let's look at the past performance, look at what has outperformed, what has underperformed, take that into consideration, and then to look forward and say, what do the outlook look like for 2011? And how does that compare to sort of the long-term forward earnings forecast for companies? So having done that for 2011, if I look back at the last year, at 2010, the two sectors that stand out as being particular underperformers for us is the construction sector, as you mentioned, and then also the platinum sector. So those are two that immediately come to mind to say, let's look at those and see if those would not be maybe two sectors that we should be looking at in terms of investment opportunities. In terms of sectors that we would be looking at, it maybe lightening the load and taking some profit off the table is most definitely the retail sector. Being the beneficiaries of that massive reduction in interest rates over the last 2 years, the retail sector has certainly performed particularly well, and we think that it's quite expensive at the moment, and that would be the one sector that we would be lightening on, and the other one would be very much the property sector. We don't think that there's a lot more in terms of interest rate reductions on the cards, and we're probably looking at both bonds and property not really doing much over the coming year, and that would be another sector that we would be short on over the next year.
And Nerina, let's unpack some of the themes that you've just mentioned and perhaps just translate them into which companies you're bullish about. Let's start off with the construction sector.
Within the construction sector, there's certainly the two mega caps, Murray's and Avenge, and if I look on a forward valuation, and maybe I just need to sort of highlight what I mean with a forward valuation. If we look at earnings consensus forecasts for companies, we can look at the forward PE or the price earnings ratios for companies based on consensus forecasts, and by looking back over the last 10 years, we can get an idea of what is the average price earnings ratio that a particular company has traded on in the past. And if we then look look at a company like Anglo American, for example, we find that in the past it has traded on a forward PE ratio of around 10.8. It's currently trading only at around 7, I think at about 7.2. So that would certainly indicate that it's trading at quite an attractive valuation. Standard Bank, on the other hand, in the past traded on a price earnings ratio of much lower, less than 9, about 8.7, whereas currently it's sitting at a price earnings ratio valuation of over 11, and that would indicate that it's expensive. So with that in mind, looking at the construction sector, we would certainly prefer Murray's over Avenge when we look at the large property stocks. When we look at the smaller ones, we would certainly be in favour of Basil Reed and Wilson Bailey rather than Group 5 and Raubex, purely looking at them from a forward valuation point of view.
Nerina, you mentioned the retail sector, perhaps, as you said, lightening the load. We had ShopRite out with sales for the 6 months to December. Some investors think that perhaps there's more room needed for growth and are not so bullish about a movement to the upside on its share price. We're sitting at around 95 Rand a share. Is this one of the stocks that you will be selling?
Yes, most definitely. I think if anything, the results were maybe a little bit disappointing yesterday, although not bad. I think they're currently finding that their cost growth is ahead of their sales growth and volume growth, and I think ShopRite would definitely be one of the stocks that we would be lightening on. You know, if we look within the food and drug retail sector, that was certainly one of the sectors that were one of the top performers of 2010. And if we just sort of expand our scope slightly beyond the obvious food and drug retailers being ShopRite, Spar and Pick n Pay, all three of them being quite rich in terms of valuation at the moment, we can look to the likes of Woolworths, for example, and we would certainly prefer Woolworths over any other of those other three. Even if we look at Massmart, which is not a pure food and drug retailer, obviously because of the corporate action and the strong price performance that we saw out of them in 2010, that would be another stock that we would also lighten on. Maybe take the profits. It's probably not going to be giving you a lot more performance leading up to that corporate action, and I think better performance can be achieved somewhere else in the sector.